My grocery bill is noticeably higher this year. I'm not imagining it. Euro area inflation came in at 3.2% as of May 2026. Now, if you're just leaving your money in a savings account or holding long-dated bonds, you are quietly losing purchasing power. Today we are going to talk about 4 categories of assets that have historically tended to hold up in inflationary periods and 2 that tend to struggle. Quick disclaimer, this video is for educational purposes only, not financial advice. So always do your own research before making any investment decisions. Let's get into it. 3.2%, that's the headline euro area inflation figure for May 2026. To put that in perspective, the European Central Bank's target is 2%. We are running above that. This isn't a spike. It's a persistent elevated level that has real consequences for anyone with savings or a portfolio. The big driver right now is energy. Energy prices are up about 10.8% year on year, more than 3 times the headline rate. This is largely a consequence of the oil shock stemming from tensions in the Middle East following the Iran conflict. When energy costs surge, they ripple through almost everything: transport, manufacturing, heating, food production. That's why this particular inflation episode feels sticky. Let's talk about cash first, because most people default to it when they feel uncertain. If your savings account pays around 2% and inflation is 3.2%, your real return is negative. You are losing purchasing power in real terms every single month. That doesn't mean cash has no role. You need an emergency fund. But holding excess cash beyond that is quietly costing you. Before we go through each category, here's the big picture framework. In an inflationary environment, assets whose value or income can rise with prices, things like equities, real assets, inflation-linked bonds and energy, have historically tended to hold up better. Assets with fixed future payoffs, primarily long-duration bonds and excess cash, have historically tended to lag. This is a simplified framework. Every portfolio is different and your personal situation matters enormously. But let's walk through each one. The first category is broad equities, a diversified basket of stocks. Over long periods, equities have been one of the best performing asset classes in real terms because companies can often raise prices as their input costs rise. That's called pricing power. Equities aren't a perfect short-run hedge. Sharp inflation spikes can trigger sell-offs. But over a 5 to 10-year horizon, a broad basket has protected purchasing power better than almost any mainstream asset class. UCITS index funds covering global or European equities are the most accessible way in. The second category is real assets: infrastructure, property, commodities, real estate vehicles. The logic: the replacement cost of a bridge, a data center, or a warehouse rises with inflation, which tends to support these asset prices. Listed infrastructure funds and REIT type vehicles available as UCITS funds are the accessible entry point. One caveat: real assets are rate sensitive. Listed REITs took real hits in 2022 and 2023 when rates rose sharply. Entry valuation has historically mattered here. Buying at reasonable prices rather than chasing recent performance has tended to hold up better. The third category is inflation-linked bonds. In Europe, these are primarily issued by sovereigns: Germany, France, Italy, called linkers, or in French, OATs. Their principal adjusts upward with inflation, so at 3.2% CPI, your principal grows at roughly that rate. Duration still matters though. A long-dated linker still carries real interest rate risk if rates rise further. Shorter maturity linker UCITS ETFs tend to offer a cleaner hedge with less rate sensitivity. Average duration is one of the details worth understanding before buying. The fourth category might feel counterintuitive: energy exposure. Energy is the main driver of this inflation episode. Painful for consumers, but profitable for producers whose earnings rise as prices spike. This could mean listed energy majors or a UCITS energy sector ETF. But treat it as tactical, not a permanent overweight. The spike is geopolitically driven and can reverse quickly if the situation de-escalates. Position sizing tends to matter here more than almost anywhere else. Letting one sector dominate a portfolio has historically added unnecessary concentration risk. Now let's talk about what to be cautious of. The first is long-duration nominal bonds, maturities stretching 10, 20, 30 years, which pay fixed nominal coupons. When inflation is elevated, those fixed payments are worth less in real terms each year, and with the ECB having limited room to cut aggressively while inflation sits above target, existing long bond prices stay under pressure too. That's the double hit long bonds have taken in recent years. The second thing to be cautious of is idle cash beyond what you need for liquidity and emergencies. We talked about this at the start. If your deposit rate is below the inflation rate, you're losing purchasing power every month. This is sometimes called the silent tax of inflation. It doesn't show up as a loss on your bank statement, but the damage is real. Historically, investors have addressed this by moving excess savings into assets that can at least keep pace with prices over time. Let me bring this together into a practical checklist. First, look at how much cash you're holding beyond your emergency fund and ask whether that excess is working for you. Second, review the duration of your bond holdings and consider reducing exposure to long-dated nominal bonds. Third, make sure your equity allocation is well diversified across sectors with pricing power. Fourth, consider whether a small allocation to a short-duration inflation-linked bond ETF makes sense for your situation. And fifth, look at your exposure to real assets and energy. None of this requires a radical overhaul. It's about calibration. A quick note for European investors. Most exposures we've discussed, global equities, inflation-linked bonds, energy sector, real assets, are accessible through UCITS regulated ETFs on exchanges like Euronext Amsterdam or Deutsche Börse, available through most European brokers. UCITS funds are regulated under EU law with diversification and investor protection standards. Always check the key information document or KID before investing. You might be wondering about gold, the classic inflation hedge. Gold often performs well when real interest rates are negative, meaning inflation is higher than nominal rates. The relationship isn't always tied short-term. Gold can be volatile and sentiment-driven. But as a small diversifying allocation, many investors include it. Whether it's right for you depends on your risk tolerance and goals. One more factor to weigh, your investment horizon. If you need the money in 1 to 2 years, favor capital preservation and short-dated linkers. For a 10 or 20-year horizon, equities and real assets are the more powerful long-run inflation protection. In the spirit of intellectual honesty, let's consider what could change this picture. If the Middle East situation de-escalates and oil prices fall sharply, the energy component of inflation could drop quickly, pulling headline inflation back toward 2%. In that scenario, long bonds would rally, energy stocks could correct, and the ECB might cut rates more aggressively. Positioning for inflation does not mean being blind to the scenarios where inflation fades. A balanced, diversified portfolio is more resilient than a concentrated inflation bet. Here's the core message. Inflation at 3.2% is not catastrophic, but it is meaningfully above the ECB's target, and it is being driven by an energy shock that shows no signs of vanishing overnight. In that environment, assets with real return potential, equities, real assets, inflation-linked bonds, energy-related equities, have historically been better positioned than fixed nominal bonds and idle cash. None of this is guaranteed. Past behavior of asset classes is not a guarantee of future results, but understanding the mechanics helps you make more informed decisions. Let's do a quick recap. 4 things that have historically held up in inflationary environments: broad equities, real assets, inflation-linked bonds, and energy exposure. 2 things that tend to suffer: long-duration nominal bonds and idle cash beyond your emergency fund. Remember, every investment has risks, and this is a framework, not a prescription. Your individual circumstances, tax situation, and goals all matter. If you found this useful, please like and subscribe to The European Investor. We publish regular educational content for European retail investors, covering everything from portfolio strategy to understanding macro events like this one. There's also a free newsletter in the description where we share deeper analysis and resources. And remember, everything on this channel is education, not financial advice. Always do your own research and, where appropriate, seek professional guidance. I'm the European Investor. Stay curious, stay diversified, and I'll see you in the next one.